Welcome back, traders. It's Monday, December 2nd. US markets will be back after a long weekend of Thanksgiving celebrations. And there are a couple of important jobs data to keep a close eye on. Friday's non-farm payrolls report and Canadian jobs data might affect the US dollar and Canadian dollar later this week. A couple of central bankers will be also on the wires, including Fed Chief Jay Powell and ECB President Christine Lagarde. So it might be another week of rate cut talks. And this video I have decided to present my analysis on dollar yen, dollar loonie, and euro pound. It seems that there are some interesting developments in these markets. So let's start first with dollar yen and the US non-farm payrolls report. The data are expected to show an increase of 200,000 in November. That's more than October's double-digit increase, which disappointed investors. So since that will be the last report before Biden leaves office and Trump comes to the office, it might be a positive report for the US dollar. Overall, investors expect another 25 basis point rate cut this month. I would rule out this case as this might be the last chance for the Fed to cut interest rates before Trump takes office. But overall, if the data come better than expected, that would help dollar yen to climb back above the 200-day exponential moving average at 150.55. Then I would also like to see an increase above the 50-day exponential moving average at 151.55 before we head towards the 153.40 region. The 20-day exponential moving average will be also under the spotlight, but I would like to see an increase above 153.40 to become more confident that the recovery phase could extend towards the 155.4 to 156 trend line zone. If we break that zone, then that could confirm additional gains, likely taking the price up to the 157.70, where this broken former support territory trend line is placed. Now, in case the data disappoint, we also have the ISM on manufacturing and manufacturing PMIs data out later this week. So if overall jobs data send negative signals about the US labor market, dollar yen could continue its bearish wave, likely reaching the 50% Fibonacci retracement of this up leg at 148.15. Then below that, the 61.8% Fibonacci of 146.12 could come next into view, a break of which could probably deliver another fast decline towards 143.50. Well, I would rule out more negative sessions given the negative slope in the technical indicators. And so we can see that the 50-day moving average has started to slow down after posting a bullish cross with the 200-day EMA. So I believe that negative risks remain in the market, but we'll probably find out when the jobs data come out later this week. And now turning to dollar loonie. Dollar loonie will also face volatility from Canadian jobs data on Friday. The pair has been more on the sidelines lately, despite spiking to a 4-year high of 1.4172 last week. But then we saw the pair closing back within the 1.40 level, and it even crossed below the 1.40 mark last week before bouncing up. Overall, we see that the market action is taking place within a neutral triangle, so a break above 1.4060 or below the protective 20-day exponential moving average at 1.3970 could provide the next direction in the market. According to forecasts, Canada is expected to post stronger jobs data later this week. But the unemployment rate is expected to tick up to 6.6%. So it might be another mixed report for Canada if if the data disappoint, if we see higher unemployment rate and weaker jobs creation, that could help dollar loonie to continue higher, breaking 1.4060 in order to test the 1.41 number once again. Even higher, I expect resistance to come around 1.4170, and if we successfully close above this barrier, then the rally could stretch towards the 1.4225 region. Now, if the data come better than expected, likely reducing the case of a 50 basis point rate cut later this month in Canada, then that could take dollar loonie below the 20-day moving average at 1.3970. Overall, I expect declines below 1.3945 to trigger faster declines. And if the 1.39 and 1.3875 territory fails to hold, then I expect a continuation towards the 1.3820 level. Well, the technical indicators don't really provide clear direction over here. We can see the RSI flatlining and the stochastic oscillator moving on the sidelines as well. So I believe that as long as we hold above the 20-day moving average, that keeps the odds for an upside reversal high. Otherwise, downturn could be likely. And finally, concluding this video with Euro Pound. Euro Pound faced another discouraging week, another ugly week, and it's currently heading towards the 0.8260 territory, where it posted a 2.5-year low a couple of sessions ago. That follows the rejection near the 0.8345 and around the 20 and 50-day simple moving averages. So that increases the odds for a bearish correction. If this support line over here fails to hold, then I expect a bearish continuation towards the 0.8170 and 0.82 level, while lower than that, the 0.8115 level could be the next destination. If we look at the technical indicators down here, the MACD has broken its positive trajectory, has strengthened its negative momentum below zero, and the RSI and the stochastics are all pointing down. Moreover, we can see that the 20-day moving average over here failed to cross above the 50-day moving average, so that's another discouraging sign for the market. So all the signals point to the downside. Nevertheless, there was a debate about whether the ECB should deliver a 25 or 50 basis point rate cut, as inflation has shown some stickiness lately. So Christine Lagarde's comments later this week will be important. If she sounds some more hawkish, reducing the odds for a 50 basis point rate cut, then that could help Euro Pound to reverse up in order to test the 0.8320 territory, where the 20-day moving average is located. The 0.8345 will be also closely watched. But I think that a break above 0.8375 and particularly a move above the 0.84 psychological mark would be more important to put this downward trajectory into question. That in this case, buying appetite could strengthen probably towards the 50% Fibonacci retracement of this downleg over here at 0.8440. The 200-day moving average is also within the same region, while slightly higher than that, the 0.8470 could be crucial, because any increases, a sustainable rally above this territory would put the pair back into a positive trajectory. So that's all for this week's important FX pairs. Thank you for watching, and see you next time. Bye bye for now.